Right, so we took a look at, in these last videos, step number 8. So we looked at journalizing and posting the closing entries. So we closed all of those temporary accounts and we got them to 0. The next step is to prepare the post-closing trial balance. So this is our final step in the accounting cycle. We prepare this post-closing trial balance, and that becomes the opening trial balance for the next year. So the accounting cycle, as I said, it ends with this last post-closing trial balance. And it's our final check at the end of the year to make sure we've posted or recorded all of our journal entries properly, we've posted them properly, and to make sure our debits equal our credits, because we always need to have that on our trial balance. Once you prepare the post-closing trial balance, or I should say that you do this the exact same way that we've prepared the other trial balances. So this is the 3rd time we're preparing a trial balance. First, we started with the unadjusted one. Then once we posted our adjusting entries, we prepared the adjusted trial balance. Now that we've posted these closing entries, we have the post-closing trial balance. So like we did in those first 2, you update your T accounts, calculate the new balances, and use those final balances to create the trial balance. Here, in this post-closing trial balance, we'll see that the only balances that remain are our permanent accounts. So those balance sheets accounts, our assets, our liabilities, and our owner's equity, or for now, the capital account. So in our closing process, we closed all of the temporary accounts to 0. So our revenues, our expenses, and our withdrawals, those should all have 0 balances. And we know on a trial balance, we only show the accounts that have a balance, so we will only see these permanent accounts. If you post your closing entries and you were left with something in a revenue or expense or withdrawal account, you would need to technically show those on the trial balance, the post-closing trial balance. But that really just means that you made an error, because when you close them, they need to all get down to 0. So you would put them in this post-closing trial balance, but it would trigger you, oh, I must have recorded something wrong in my closing entries, or done the math wrong in my posting and calculating the balances, and you'd want to go double check that, because you should only have those permanent balances that remain. Okay, so this was the question that we went through, E4-7. So in the previous video, I completed this. We prepared the entries and we posted them to the T accounts. So you would have this in your example that you did. Now we're going to use this and we're going to prepare the post-closing trial balance for Lipsky Insurance. So we're taking all of the accounts that have balances, which we've got a 0, 0, 0. Okay, here we have an asset balance. 0, 0. We've got liabilities. We have cash. 0 on our revenues. AP, we have a balance. Our rent expense is gone. We've got accounts receivable, and we have the capital account. So the only ones that we have left are our balance sheet accounts. Our assets, liabilities, and this capital account. So that does tell us that we've closed all of our accounts, because we should only have balances in these permanent accounts. So we're just going to carry these over and we will create the post-closing trial balance. Remember, you always name it with the company name, that it's the post-closing trial balance, and the date that we're preparing this at. And we record our trial balance with assets first, then our liabilities, then the equity, revenues, and expenses. Here, we should not have revenues and expenses. So the first account that we'll use is our cash. We've got the $2,900. Again, I changed this from what the textbook said. It said 1,000, but if we use that, things just wouldn't work out. So I've updated this to cash $2,900 debit. The next one that we can see as our asset is AR. So we'll post that. Or not post it, but move it over. Accounts receivable. And it was $1,200. And then we also had these other assets of $500. Okay, so those were all of our assets. Now we pick our liabilities. So we've got AP and long-term liabilities. So our accounts payable. And that was a credit of $300. We also had long-term liabilities. Which were $400. And then the last account that we haven't picked up is our capital account. So a balance of $3,900. Whoops, hit the wrong button. Oh, technology is getting the best of me in chapter 4. So C. Lipsky Capital. And the balance was $3,900. So we always need to do our double check. Do our debits equal our credits? So we add up our debits. We get a total of $4,600. And if we add our credits, we also get $4,600. So our totals match. And that is a check for us to know, okay, hopefully this means we've carried everything over properly because our debits equal our credits. And that is why I had to update this cash amount. So this question didn't particularly follow through to the post-closing trial balance, but because I wanted it to, if I had used the $1,000 in cash that it gave us, we wouldn't balance here. So that was the why I had to update that. Okay, so that is a look at the post-closing trial balance, our final step. It's not too hard, but you just need to be noting you would only have the permanent accounts left. So only assets, liabilities, and the capital account. Okay, so just a quick review. These are the full set of 9 steps that we went through. So we analyzed our transactions. We decided, is this a business transaction that needs to be recorded in the accounting records? We looked at what type of account, was it an asset, liability, or so on? Is it increasing or decreasing? From there, we learned whether we debited or credited it. And then we did that. We actually recorded the entry in step number 2. So we recorded those transactions. Our debits equaled our credits in each entry. Once those were posted or recorded, we post each entry into the general ledger. And for purposes of our course, we use the T accounts as our ledger. So we're tracking these same entries, but now we're sorting them by account rather than by date. Once we've got all of those journal entries posted and we calculate the balances in our T account, we use those balances and prepare the unadjusted trial balance. But we know at the end of the month, there's often these adjustments needed because we need to recognize our revenues in the period that they were earned and recognize our expenses in the period that they were incurred. So typically we have to do this through these adjusting entries. So we've either got our prepayments that were sitting in the balance sheet as either like a prepaid account or supplies or as the unearned revenue, and now we need to move those into revenues and expenses as they've been earned and occurred. Or we had adjusting entries for accruing revenues and expenses. So the cash has not been paid yet and nothing's been recorded, but because the revenues and expenses are earned and incurred, we need to accrue those or set them up. And then we also looked at amortizing our PP&E. So those are all the adjusting entries. You record and post those in step 5. And then once you find the new updated or adjusted balances in your T accounts, you prepare the adjusted trial balance. That is the trial balance that we use to prepare the financial statements. So we prepare the income statement first, then the statement of owner's equity, and finally our balance sheet. Once those are prepared, we've done the full year. We now need to close our accounts, close those temporary accounts in order to get the trial balance updated for the next year. So we record and post the closing entries. So we just looked at these: close revenues to income summary, then close expenses to income summary, then close the income summary to the capital account, and finally close the withdrawals to the capital account. So we record and post those to the T accounts, and then this last step is preparing the post-closing trial balance. And then this is the end of the year. You would start back over and start with step 1 the following year. So you would do this again, and this post-closing trial balance, that becomes your opening balances for the T accounts when you start the next year. Okay, so that's the accounting cycle. And in the next video, we will take a look at the classified balance sheet. So we did talk about this a little bit in chapter 1 when I did the example for craft brewery, but now we'll go through it in a little bit more detail and look at some ratios that we can calculate from the adjusted trial balance. Or sorry, not the adjusted trial balance. I was looking at that. We'll look at the ratios we calculate from the classified balance sheet.